Hi, welcome to Out of the Rough. I'm Fred Arnold, and in this show we're going to highlight opportunities and solutions to help get you out of the rough and into success both financially and personally. In these tough economic times, I want to bring to you practical solutions to many of today's challenges. Today we have Barry McKeever with Premier Real Estate, and we're going to talk about real estate. Barry's been in the Santa Cruz Valley for the last 20 years and an expert when it comes to real estate and real estate financing. Welcome to the show.
Well, thanks, Fred. Thanks for having me. Appreciate it.
I want to talk about something in particular, and the real estate report just came out for the realtors, and it says housing recovery stalled in 2010, but the median price was up. Let's kind of cut through that headline and what is really going on out there.
You're going to get the tough stuff right away, aren't you?
Yes. Let's find out what values are doing and what's going on with the housing market.
Well, right now, I think in the overall scope of the value of the market, the market's still trending. Values are trending downward. When you have these surveys and everything and stories that come out, especially from the media, with median and average prices that go up, that doesn't necessarily mean the values are going up. It just means that the average of the homes that were sold for that period are going up.
Well, let's break that down because that is an interesting concept. Because when the entry-level homeowner, originally when our market started to collapse in 2007, fall in 2007, it was the entry-level homes that were really getting hit first, right? Bringing down the average sales price because the higher-end homes weren't even selling.
Exactly.
So let's go deeper on that.
Well, the thing is this has been kind of a twofold economic catastrophe, so to speak, with what's gone on with real estate. The first one is I always say it's last in, first out, and that's basically your condo homeowners, your entry level, your lower valued homes. People that bought at the $300,000-$400,000 level may not have been able to afford at that time, and then once the values just crashed, they were the first ones to get out of there. They couldn't afford it. You saw all the foreclosures. Most of the foreclosures and REOs that we saw, and this doesn't mean it didn't happen to the higher end, but most of them were those lower end homes, and they got hit really hard, and now when they got resold on the market, you had the average and median go way down. Now I think we're in kind of a second phase here where you're seeing the people that bought maybe at $700,000, $800,000, $900,000, $1 million, $1.2 million, can't afford them, are seeing their home. Maybe they lost $500,000 in equity. They're upside down, and they've come to a point where they've decided they're going to short sell or they're going to lose the house outright. But now those are starting to come through the wash and through the pipeline,
thus increasing the average sales price, right?
Absolutely.
Yeah. Interesting dynamic because we're seeing more of those homes actually sell, the higher end homes. Whenever you have a crash like we did, the ones that are going to lose their homes are the ones with the least amount of resources.
Correct.
The ones in the case of subprime lending had the most subprime, so we saw those. But there also wasn't a whole lot of financing for more expensive homes, so those homes just weren't transacting.
Well, exactly, and when the financing piece basically got subtracted from the equation of real estate, and those people couldn't get refinancing or couldn't bail themselves out, and we've seen this time and time again. People, especially at the high end, have been able to try to hold on. They have more savings, they have more disposable income, but there is a certain point where those people now are starting to say, it's just not financially feasible for me to hang on to that home anymore, and that's where you're seeing now $700,000, $800,000, $900,000, $1 million. These homes are now coming onto the market, and that's, quite frankly, it's almost balanced between. It used to be all the homes that were on the market were a bunch of REO, lower valued homes. Now you're seeing the very nice Stevenson Ranch, Valencia, higher end of Saugus, Canyon Country, Sand Canyon are going at the short sale in the right at even just less than $1 million, even sometimes more.
Yeah. Now you'd mentioned that we're in agreement. Values are dropping just slightly, and I don't think they're in a free fall like they were, but they're dropping ever so slightly. More people that are in trouble that had a loan modification can no longer afford it. Those are going back on the market. But let's break it down just a little bit. Right now it's about values dropping but interest rates rising. Mm-hmm. So there's a dynamic there. Explain that.
Well, it's a very difficult dynamic because you've got, I see buyers in the market today. I see two different types of buyers. One buyer is the buyer that's walking around with literally a sack of cash. I've got one listing right now that sat for 6 months. I took the listing in September and it sat for 6 months. It started off at $650 and came down and finally was $579. And literally over the last month, I've gotten 4 offers and 2 of them are all cash. And these people, a lot of them are foreign money that are coming in with the cash, and they were waiting for the market. And there is is this perception now that we fit at or near bottom of the market. So a lot of this investor money, a lot of this all cash now, people who have been sitting on the sideline are now coming in.
But they're looking for deals.
They're looking for deals, and they want deals because they have the cash, and they have the cash. They can close it. They don't need the financing piece, and quite frankly, they're getting them as well. But they're also, I'm finding too, is they want the higher end. They want the nicer homes, whether it be for a family member or they're going to keep it as an investment. But they want that $400,000, $500,000, $600,000, $700,000 house. So you have those kind of buyers. Then you have the average buyer, I call them, which is guys like you and me that to go out and need to get a loan for the piece of property have to put more money down. But as you're seeing the interest rates go up, even 0.5% and 1%, on a $400,000 or $500,000 loan, that's going to make a lot of people, especially now, not be able to qualify because that you don't have that play that we used to have in the market several years ago.
Exactly. It's a yin and a yang. You have interest rates going up a little bit and values going down. I think it's about finding the right house in this market. It's about finding the house that has the perfect swimming pool if that's what you're looking for. It's the perfect kitchen if that's what you're looking for. Find the house that you're looking for because a couple things are going to happen. One, it could potentially go down in value a little bit over the next 12 months. But that interest rate is certainly going to go up with the fact that we're printing money as a country, with the fact that oil prices are going up, with the fact there's so many things that are going to eventually drive some inflation in this country. Maybe not hyperinflation, but some inflation. I want to jump to inventories real quick. We got about 2 minutes, and I want to talk about inventories. And inventories are up. And I think it's artificially up at this point because there's a lot of homes on the market that are actually in escrow to sell, but they're short pays and they take a long time to close.
Well, yeah, because when you say the inventory, these it used to take, you put a home on the market, you sold it in 30, 45 days, you had a 30, 45 day escrow, 60 to 90 days, 120 days it was off the market, on and off. It's just not working that way nowadays. When you have the majority of the homes that are short pays, in some markets like we have in Santa Clarita, anywhere from 40 to 55% are short pays. What you have is you have a bottleneck of homes that are in what we call a backup state. What happens is it's a property that's taken an offer but is not open to escrow, has not been approved by the bank, so it's at the bank, the bank's approving it, and that process could take anywhere from a month to 6 months to 8 months. We've seen, sometimes,
the short pay process is painful.
It's a very painful process. So I think you've got this inventory. If I pull up 10 comps on your home, I'll find 2 are active, 6 are in backup, maybe 2 are pending, and then a couple sold. And
so there's really not as much inventory as we think there is.
Really is not. And especially now, the inventory that's out there, you have the separate types of inventory, and the homes that are nice. If you're going to sell your home right now and it's priced right and it looks nice and there doesn't need to be a lot of repair and it's a standard sale, it is literally flying off the market.
Because it's a regular sale. People can close escrow in 30 days. We're going to jump to a quick break, and when we come back, I want to talk to Barry about 2 different markets, and that is the different segments of our real estate market when you're buying a house. And I also want to talk about short pays and how, if you're really challenged and you need to get out of the rough in your house, how you can sell your house quickly on a short pay.